So back in high school, when I used to run cross country, our cross country coach would take us through a series of training. And one of the things he used to do was make us run something called the washboard. And the washboard was a series of hills where we'd go up and down and up and down. I hated the washboard. In fact, I hated it so much, I used to not even think about it while I was doing it, all waiting to get to the flatlands so we could get to the end of practice. Now, these markets are starting to feel like washboards where we're going up and down again. I want to talk about a stock and a sector this week that can help you get past the washboards and see the finish line. So, let's get to training. Hey everyone, Tom Gentile. Welcome to the Trading Room. You know what we do here, even in the confessional here. What do? Well, we talk about spotting opportunity, creating alternative risk trades, and planning, exiting, and managing those trades. In this video, I want to show you how to get through this market turbulence by going into an area right now that's getting absolutely no love. All right, I actually wrote an article on this recently, and I thought I'd spend a few minutes on this video talking about utilities. So if you take a look at the last month, let me blow it up on the screen here for you. Take a look at the last month. You're going to see that it was a great mid-August to mid-September, right? In the last 30 days, we've seen 7 of the X sectors, all right, XL sectors, go higher, and 3 were just below break even for the month. Number 1, no contest at all, and not surprisingly, the real estate sector, because it continues to be on fire. But number 2 is XLU, the utility sector. If you see it on the screen, it's actually been up around just under 3.5% in the last 30 days. Now, is the utility sector telling us something that we need to know about the market? Because when I go back and I look at the money calendar, I see us coming into the rest of this week, and we start to hit some pain as far as history has told us. And history has told us during this 3rd and possibly 4th week of September, we should expect to see some turbulence in the market. In fact, we're already seeing it now. And going back 10 years, 90% of the time, it is hitting the most popular stocks where we see small pullbacks and small corrections into at least getting into that last week of September. So what do we do about that? Let's go back and take a look. Number 2 on the screen is the XLU. Now, within the XLU, I want to share with you this. 20 stocks, the top 20 stocks in the energy sector right now, in the utility sector, are actually beating the XLU in terms of price in the last 30 days. The other thing that looks really interesting about them is they all have some pretty good dividends. In fact, the top 3, over 4% dividend yield going forward between now and this time next year. So let's take a look at what I believe is one of the best ones, and that is Entergy, symbol ETR. Right? So backing up a moment, finding ETR on the list, we're going to see that Entergy has a 3% dividend. That's fine, but it is the most powerful of the utility stocks when you're looking at bullishness in the marketplace. But if you're looking to buy this stock and you're looking to capture dividends, then there is another way other than owning the stock to capture dividends and also create some protection in the event that the utility sector flattens out. So one thing, like I said, we could do, we could buy the stock with the recent areas of resistance at 110, right? 110 resistance in May, 110 resistance in June. In July, we hit 110. We went right through it. Now resistance is trying to become support. So I think there's a lot of support here in ETR around the 110 area as it continues to make new highs for the year. So how can we trade this other than buying the stock? Well, what we could also do is something called a covered call. A covered call allows you to buy the stock and write a call option near the money, capturing additional premium and therefore padding this position. Lower cost, lower risk. It pads it in case we get a pullback. But the one thing with covered calls is that the stock could get called away from you. So just keep in mind, when you write covered calls, make sure you're happy to get out of the stock if the stock continues to go higher and that call option goes in the money at expiration. This is a case study looking at the December 17th covered calls, buying 100 shares of ETR, selling the December 2021 115 calls for $2.50. This whole trade together. Now, it drops the cost down by $2.50, but keep in mind what we're trying to do is capture additional premium over the next couple months and at the same time still be able to keep that quarterly dividend that's coming along, right? You have the same risk to the downside that you do as a stock. You just have lower risk because you've captured call premium. You do have limited upside gain. So if this stock were to rise above 115 or above, you could see the stock called away, but you do achieve maximum profit on the trade. So in summary, the covered call trade is not something I talk about a lot. I don't share enough love with this particular trade, but you can do it on any stock that has options. I just showed you in this video how to do it with a group of stocks that typically go up when the market goes down. Hope you enjoyed the video. I got more to come. We'll see you then. Bye now.